Stocks have seen some return of volatility, and the laundry list of headwinds continues to pile up. From the government shutdown to higher inflation, looking at valuation concerns to geopolitical concerns, and the list goes on. But we're also seeing a bit of a rotation start to take place, where some of the retail names, the high flyers, we're starting to see some profit taking happen, and some of that money's being moved into some sectors that have been underperforming, that have lagged the greater market, and have a lot of catching up to do. So although there's not as many cheap stocks in the market as there once was, there's still plenty out there. And in today's video, we're going to uncover 3 stocks that I believe are cheap and are worthy of a buy at current prices. And we're also going to look at a few option plays that I'm interested in taking as well. So make sure you stay tuned throughout the entirety of today's video. And if you haven't done so yet, make sure you hit that like button, subscribe to the channel. I truly appreciate it. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And at the start of today's video, I talked about volatility ramping back up. We have seen the VIX climb back above 20, touching as high as 28 this week alone. And investors need to be laser focused. A higher VIX can lead to higher volatility, and investing blindly can lead to massive losses. Investors need to invest with a plan. Investors need to invest based on facts. And for me, when performing analysis on stocks, my go-to platform, which is a one-stop shop, is Fiscal AI. With the use of this platform, they make researching stocks easy, whether you're a new or seasoned investor. You can look at the latest financial results, earnings calls, and even valuation. On top of that, you can see their non-financial data, like number of rides in case you were researching Uber, or premium subscriptions if you were researching Spotify. Tons of great tools. It is a powerful platform, and by utilizing my special link in the description below, you can get 15% off any of their paid subscriptions. And the best part, they're going to give you a free trial at the start. So what is there to lose? Head down to the link and try Fiscal AI today. All right, let's jump back into our video looking at 3 stocks that I believe are relatively cheap. Beginning with stock number 1, which is going to be Uber Technologies, stock ticker UBER. And when it comes to Uber, it is one of my favorite growth stories and one of my favorite growth stocks on the market today. They've been under pressure here and there with a lot of data that comes out centering around robotaxis. And I'm not ignoring robotaxis, but in my belief, I think there's room for both. However, when it comes to valuation, there's a lot of folks that are discounting Uber and think it's going to go by the wayside. And I think that is overblown. And when it comes to Uber, they currently have a market cap of $204 billion. They operate in the industrial sector, which some disagree with, but they are an industrial company. Over the past 12 months, shares are up 15%, and year-to-date up 46%. And for a while, it was one of the best performing stocks in the S&P 500. Let's now dive into Uber a little deeper utilizing Fiscal AI. And looking at this chart here, and again, you have the ability to build any chart you want within the platform, but here I selected revenues, operating income, and operating margin. Revenues continue to climb higher, which is great, but more importantly, as of 2023, the company is finally operating in the plus territory from a profit perspective, and that is climbing as they are on the cusp of surpassing operating margin of 10%. Looking at another chart here, we can see the red bars equate to operating cash flow, the green bars being free cash flow, and we can see that both have been moving higher nicely. And like I've been saying, when a company finally crosses over into the positive territory, it can snowball in their favor, which is exactly what's happening with Uber. And when it comes to Uber, they're not just a ride-sharing company, but they have delivery and freight. And this chart represents total gross bookings, which again continues to climb higher as the company grows larger and larger in popularity with consumers. So again, the financials look great. This looks like a very solid company, but that doesn't necessarily mean it's one that we should invest in. Valuation has to make sense. In terms of valuation, over the past few years, the stock has traded at an average PE multiple of 33.4 times. Right now, you can pick up the stock for 29 times, but using the full 2026 EPS estimates, shares are actually only 26 times, which is incredibly cheap for a company like Uber. When we go over here, we could see the estimates, and we could see that analysts are looking for the stock to grow its earnings by 22% next year and 25% in 2027, giving the stock a 2-year average growth rate of around 23%. Using the forward PE multiple and that average growth rate, we get a stock trading with a PEG ratio of 1.1, which is very intriguing. Analysts agree, as they give the stock an average 12-month price target of $111 per share, indicating 20% upside from current levels. But let's say you're concerned about the overall market, not just Uber in general, but you think there could be a bit of a pullback and you want to take a more conservative approach. Well, that's where options come in. And we can look at Uber saying, we like the value now, but what if it dropped another 10 or 15%? We would love the valuation. So in this case, we could utilize an option strategy such as a cash secured put and generate income while waiting to buy a stock that we want to buy at a price that we would love to buy it at. So if you really like the stock, we could look here at the November 21st $85 put. And by selling that put option, we could earn around $225 in premium. But if you wanted to be just a little more conservative, we could look at the $80 put, again expiring on November 21st, and that would earn us around $115 in premium per contract. Those would be two option plays I would look at, because if the stock falls that low, I would be all over it. And that's going to lead us to cheap stock number 2, which is going to be Sprouts Farmers Market, stock ticker SFM. And although this is a new stock to this channel, it's not new in any shape or form to the Roussin family, as my wife frequents Sprouts on a regular basis for our fruits and vegetables. Sprouts is a grocer with a farmer's market type feel. They have a big footprint here in California, which is where I'm at, but they're also expanding across the country with more than 450 stores in 24 states. So part of the excitement centers around expansion. The company currently has a market cap of $10 billion, making it the smallest on our list today. It operates as a consumer staples company, and over the past 12 months, shares are down 4%. Year to date, though, down 16%. At two separate points this year, shares of SFM were up roughly 30%. So it's been a whirlwind of a year. Sprouts does focus more on that wealthier type clientele, so it does kind of shield them from any consumer troubles for the time being. However, we have started to see the trend going lower for consumers overall. As you can see here, consumer spending in general has been taking a hit, evidenced by the collapse in a personal savings rate in general. So a weaker consumer, combined with higher inflation, has definitely put pressure on shares of Sprouts over the past few months. However, for us long-term investors, this could provide a great entry point. Let's dive a little deeper into Sprouts Farmers Market with the help of Fiscal AI. And looking here at this chart, I again selected revenues, operating income, and operating margin. Revenues continue to climb higher, sitting at a record $8.4 billion over the past 12 months. But more importantly, margins are at a record high of 7.6%. Again, not a high margin business by any means, but close to 10% is fantastic for a grocer. In this chart, I compared two other popular grocers to give you an idea on how well Sprouts is doing in the space. The other two include Kroger and Albertsons, and as you can see, Sprouts is blowing them away. Looking at another chart here, we can see the company's operating and free cash flow growth, both firmly sitting at all-time highs. Now let's jump over to valuation, where we can see over the past few years, valuation got a little ahead of itself, as no grocery store should be trading near a 40 times earnings multiple. But right now, the forward multiple sits at 19.7. And when you use the full 2026 estimates, it's closer to 18 times at 18.3. Earnings are expected to grow at 14% next year, giving the stock a PEG ratio of 1.27. Analysts are also very upbeat on the stock, much more upbeat than me, and I'm upbeat, as they give a 12-month price target of $175, implying more than 50% upside from current levels. And this is with analysts recently adjusting their price targets lower. But again, let's say that you want to approach this a little bit more conservatively while also generating income. We can again look at a cash secured put strategy. As such, we can look to sell another cash secured put. And if we look at the $95 strike expiring on November 21st, we could generate around $200 in income. And if we purchase the shares there, we would be buying at a forward earnings multiple of just 15.5 times, which would be extremely intriguing. These are just a couple of examples on how you can utilize options to not only generate income, but also build your portfolio. And I often say it, that options can take your investing to the next level. And if you're interested in seeing all of my option plays, then consider becoming a subscriber to my Options Edge Plus community. We have a full Discord community where you can see both when I enter an option trade and also when I exit an option trade. Check out the link down in the description below. And that's going to lead us to cheap stock number 3, which is going to be Eli Lilly, stock ticker LLY. And when it comes to Eli Lilly, it's one of those sectors, the healthcare sector, that has lagged the greater market. And this is a GLP-1 leader that has been under pressure, both pricing pressures from the government and also margin pressures. But we have seen this roadmap before, and almost every time it has been a great time to buy for us long-term investors. In fact, this is a position that I recently added to on the dip. The stock currently has a market cap of $757 billion, making it one of the largest companies on the US market. As I mentioned, they operate out of the healthcare sector, but over the past 12 months, shares are down 13%, and year-to-date up just 3%. And as you can see from that chart, it's been a whirlwind year for Lilly shareholders, as early on in the year, shareholders were up as much as 20%, and now they find themselves pretty much flat on the year. The great thing about Lilly is, yes, it is a leader in the GLP-1 space, which is expanding in itself. But the other thing that's expanding is the pipeline, to where they're not going to be as heavily focused on just GLP-1 results. And when we see headwinds like this, pricing, these are near-term headwinds, which again is a great time for us long-term investors to buy. So now let's dive into Lilly a little deeper with the help of Fiscal AI, where looking at this chart, and this is a great looking chart from a performance standpoint, we're again seeing revenues, operating income, and operating margin. Revenues continue to climb higher, sitting at a record $53.3 billion over the past 12 months. But more importantly, look at these margins, a record high of 32.4%. And unlike what we saw with Sprouts, healthcare, you can find some solid margins. Looking at another chart here, we could see both operating cash flow as well as free cash flow. And looking at it, you might say, well, operating cash flow looks solid, but free cash flow has dipped and still sits below the 2022 levels. Well, to help explain that, we can see just how much the management team has been investing in its pipeline through capital expenditures. And since 2022, CapEx has grown from $1.85 billion to $6.1 billion over the trailing 12 months. Some investors shy away when they see CapEx figures explode like that. But my rule of thumb is if I see high CapEx, I better see results. And we are seeing the results when it comes to Lilly. Higher margins, higher revenues, and so on. They're building out their pipeline for the future. Now let's jump over to valuation. And on a PE level, shares trade at a forward multiple of 28.9 times. But again, using the full 2026 estimates, that comes down to 26.4 times. From an EV to EBITDA perspective, we can see shares at 41.6, well below their 5-year average of 50 times. Looking at the forward estimates, we can see EPS is expected to grow 33% next year and 22% the following year, with a 2-year average around 27.5%. Using the forward PE of 26.4 times, we're looking at a stock with a PEG ratio below 1, which means the forward growth is being underappreciated right now by investors. And now is a great time to add to the name. Analysts are also very upbeat in the stock, giving it an average 12-month price target of $947 per share, implying nearly 20% upside from current levels. And given the fact that this is a high-price stock on a per-share basis, I'm not even going to give you an option play here because the cash requirements would be quite high, especially if you're looking to do multiple contracts like I regularly do. So there we have it, 3 very different companies. We have Uber, we have Eli Lilly, and we have Sprouts. 3 different sectors entirely. And I'm always constantly trying to give different ideas for different types of investors, growth investors, dividend investors, and so on and so forth. So let me know down in the comment section, which of these 3 stocks are you most intrigued by? Which of these 3 stocks would you be willing to buy at current levels? Thanks again for watching. If you found any value, I'd really appreciate it if you hit that like button down below, subscribe to the channel, and we'll see you in the next one. Take care.